Hey, everybody, and welcome back to another episode. I've got Dustin Heiner today. I'm excited to jump in with him. We had a good conversation a little bit earlier. This guy built a multi-million dollar real estate portfolio, retired at the age of 37. He's the host of the Master Passive podcast, one of the top podcasts, by the way, on Apple Podcasts. You got to go check that out if you have not yet. Dustin, welcome to the show.
Brandon, what's up, buddy? Thank you so much for having me on the show. And yeah, I love real estate investing. I started back in 2006, just kept buying property after property, trying to get cash flow so I didn't have to work anymore. And then I became successfully unemployed, is the term I like to call it, instead of retired, because people don't understand. Like, oh, you're retired? You're 37. How are you retired? But anyways, so I go to the gym, hang out with my family, and don't work a job. And then I get to come on podcasts and talk to great people like you. So thank you for having me on.
Yeah, tell me a little bit about that. So you're successfully unemployed at 37. How old are you now? And then how do you spend your time?
Yeah, I'm 46 now. How I spend my time now is I go to the gym 5 days a week, 2 hours a day. In fact, that's probably one of my favorite things to do. Go play golf, hang out with my family, do a podcast here or there. But majority of my time is taken up by coaching other people now. I got 30 plus single family homes, residential, each one making me four, five, $600 a month. When I bought them, 10, 15 years ago, now they're making me a lot more money than that. But a lot of my time is taken up just by being around doing fun things that I like to do, because that's my main reason to become successful employed, was have freedom in my life to do whatever I want. But then now I'm just like, man, how do I help more people to invest in real estate? My mission right now is to help 1 million people to invest in real estate, hopefully become financially independent. And it's a lifetime goal, like a mission in life, because I've coached thousands of people now, put on conferences where you get 400 or 500 people, all just helping people to invest. And when they are getting their first property or getting 10th or becoming successful unemployed, I feel more fulfilled in my life, because I don't need the money. It's not for me. It's basically, how do I help more and more people?
Okay, so you spent a lot of time on the coaching. Yeah, that's you're going to have to do something. That's usually where people tend to gravitate to, is the giving back, the coaching, because that's really what gives you fulfillment. A lot of money, a lot of people get really bored really quick. Right now, I would argue, has been the most difficult time to build a single family rental portfolio because of what rates have done since 2022. It has been extremely difficult to get properties to cash flow because you just haven't seen the crazy price. You haven't seen the prices come down enough to justify, the mortgage almost doubling in the last few years. How are you combating that, or how are you teaching others to combat that? Are there still single family rentals out there that
Oh
pencil
yeah,
and cash flow?
absolutely. There's a ton, but here, I'll say it this way too. You'll probably never hear anybody else say this. I am actually sad rates are going down. I'm actually sad rates are going down, which is, people are like, well, Dustin, what the word are you talking about? Well, I want rates to go up. I've been hoping for rates to go up for a very, very long time, because before I get to there, what people have said to me is like, Dustin, why do you coach people? Aren't you coaching your competition? Buying properties. Like, no, I'm actually not. In fact, this is fun. I enjoy helping people, but who are my competition, or our investors? Who is the competition? Homeowners. When interest rates go up, it prices homeowners out of the competition. So they're not overpaying for properties. They're the ones that overpay for properties. They're the ones that fall in love with the property, and then we can't buy them. No, when interest rates go up, then it prices them out. Prices do come and eventually will correct down and be fitting with the interest rates. But here's the amazing thing, Brandon, you understand this. I don't pay my mortgage on my properties. I don't pay for taxes. I don't pay for property management. I don't pay for repairs, meaning I don't have to get a job to pay for that interest rate or the property management, or I don't have to do that. I make sure before I buy the property, all the expenses are taken care of. And one of them would be the mortgage payment, which obviously comes from the interest payment, the interest rate that we get. And so honestly, it doesn't matter what interest rate that I get, because in the end, as long as I buy the property right, and I'll give you a quick example in just a second. As long as I buy the property for the right price, gets the expenses lower, because your biggest expense is your mortgage. If you can get that mortgage lower, then you get more cash flow. I just bought, this is the example, is a couple months ago, I bought let's see, it's about $140,000 property worth $140,000. but I bought it for $67,000. It was off market. Another investor was offloading that property. It cost me about 20 grand to fix it up. So I'm out of pocket, let's say close to $90,000 for this property. Well, I captured about 100 and no, sorry, not 100, 40 to $50,000 in equity or more, maybe even 60, depending on what the market value is. But I capture the equity. But when you think about it, my mortgage payment is so low. So the cash flow is high. Now you might be thinking, and a lot of people, like if you're listening, you might be thinking, well, Dustin, like how do you find those properties? Well, when you become a business owner and you don't just go on the MLS and have realtors send you deals, when you become a business owner, you have other people wanting to send you deals, like wholesalers, other investors. In fact, that's how I got that one. Other investors.
Mhm.
I've even had title companies sending me deals, property managers. Everybody for the last 20 plus years they've known me as an investor. And so I get so many deals sent to me because I have so many people knowing me as an investor. I buy properties and then I make cash flow from them. So with interest rates, I want them to go up even higher because then they'll keep prices stabilized or even come down some. But at the same time, I'm not paying the interest on my property. The tenants are.
Yeah. Well, I think the issue a lot of people are having is like properties that used to cash flow don't cash flow anymore just due to the mortgage. So, what's your workaround in that? Just the deeply, deeply discounted off market properties, the out of town landlords that the property's
There's
destroyed. They don't want to fix it up anymore. And it sounds like you're getting it at a steep enough discount and fixing it up where maybe you're not doing the Burr method. Maybe you're keeping a little bit of equity in there to keep the loan, the mortgage really, really small so that it does cash flow. I mean, walk us through some numbers.
Yeah. So there's two ways to do it. Number one is lowering expenses, like you're talking about, trying to get the price lower. So if we lower expenses, then the cash flow is going to work out. The other way is increasing income. Now, increasing income, we'll get to that in just a second, but let's talk about the expenses. Your expenses, number one thing, like I said, was your mortgage. And if you approach your investing as a business owner, you're going to buy your inventory. When I say inventory, your property is your inventory. You got to realize that. And I'll say something that you won't hear anybody else say this as well. So you need to stop thinking of yourself as an investor. When you think of yourself as an investor, you could tend to get, and more often than not, get to where it's like the stock market. You put your money in the stock market and just hope that price of that stock goes up, and that's you're investing your money. Even though we invest our money in real estate, we need to be focused as a business owner because in a business, you invest for cash flow. Let me give you a quick example of what that looks like. So, if you're going to start a convenience store, candy bars and soda machines and all a good store, a store for that, you would not sign a lease on a location, set a box of candy bars in the door inside the door as you open it up, and hope to run a business. No, you go out of business in 2 seconds. What you would do instead, though, is you would build the entire business first. You get the gondolas, those are the shelving units, all the candy bars go on, the countertops, cold storage, bank accounts, cash registers, employees, insurance, like everything in the business before you buy any inventory. Then once you have the entire business built, then you buy the inventory and you put it into your business. Same thing with real estate investing. In fact, I did it the opposite way. What the quote unquote, like maybe TikTok gurus back when I first started investing, it was infomercial gurus, what they told me. And I followed what they told me. And in the end, 6 months later, my property manager started stealing from me because I didn't know what I was doing. But then if I would have hung my head and said, oh, it just doesn't work, then I wouldn't be here today and being able to share this with you. But I realized was I needed to build a business. And before I bought a property, I went ahead and found the experts who are going to make sure I buy the right property. So before I get any further on building the business, which we can get into more, quickly get back to your so expenses. Keeping your expenses as low as possible. Mortgage is one, so you get the price of the house lower. You do not buy it unless the price is low enough to where you make cash flow. And I suggest $500 a month. The other way is getting your income up. Long-term rental is amazing. I love long-term rentals. In fact, that's predominantly what I have. But some other properties that I bought at long-term, it wasn't going to cash flow enough. So what did I do? I did midterm rental instead, or even short-term rentals. So we figure out a different way to get the income up. So long-term, stable, which is great, but you get lower amount of rent. Midterm, you furnish the property 30, 60, 90 days. You get traveling executives, nurses, and all that sort of
Yeah.
stuff. And then they stay in the property and your price or the rents are higher. But then short term, a lot more turnover, a little more expenses, all that sort of stuff on that end. but the price is higher. You make more money. Another one that's really going to take off, I think now it's already taken off, but it will take off even more, is co-living. Co-living where people just rent per room. That makes you so much more money. So the what you do in order to get cash flow, get your expenses as low as possible. Don't buy it unless your expenses are low enough, and then figure out the best use for that property, whatever income that could be, short-term, mid-term, long-term, or even co-living.
It's interesting. You're the fourth person to bring up co-living in the probably the last 4 months. I had another guy on the podcast who has a coaching program around co-living. And I was like, huh, and it seems like in college, I did co-living. I remember, as a college student, it was very popular. All college students did the co-living thing. The landlord was renting out each room, and the person who signs the lease brings and finds the roommates. It's kind of nice. And it's interesting because with the rise or the fall of affordability, you're seeing people get more creative on how to live together. So that's really interesting. Now, how you talked about being a business owner instead of an investor. I get that. How did you go about creating the business, and what are some of those key differentiating factors between thinking like an investor versus a business owner?
Yeah. So if you're an investor, you're going to do what I did, which is I was taught by those infomercial guys back in 2006. I started investing back in 2006. And in 2008, 9, and 10, when the crash happened, I was really worried about losing everything because every single other real estate investor was. And the opposite happened. I made more money. And the reason why is I was not investing or speculating, hoping that the values of the properties would go up. I only invested for cash flow. When I bought one property, I made sure it was going to make me $500 a month. And so the people who did go bankrupt in 2009 and 10 is because they were hoping for the value to go up. Now, sadly, the value did go down, but my rents went up. And the funny thing about that was, or sad for other people, but let's say this happens again, but this is what's going to happen. If the economy goes down, then sadly people are going to foreclose on their homes, but they have to live somewhere. The pool of renters go up, so supply is still the same, demand goes up. And so my rents went up. Now, when you're approaching it as a business owner, getting back to your original question, when you approach it as a business owner, just like I talked about that convenience store analogy, here's what I also suggest. Let's say, and there's another analogy, let's say you had a candy bar business. You could buy a candy bar for 50 cents. And every day, all day, you could sell it for $1. You'd be thinking, man, I'm going to buy as many candy bars as I can because I can make 50 cents. The great thing about real estate investing is you want to make cash flow every single month. And so you would not buy that candy bar for $1 if you could only sell it for $1 now. And you're hoping in, like, let's say a year from now, you could sell it for $1.50, $2 or something. We don't do that.
Yeah.
When you go into business, you go into business to make money on every single transaction. Same thing with real estate investing. You buy that property, and one of the expense line items, along with your taxes, along with your insurance and mortgage payments and repairs, vacancy factor, all those other expenses, your expense you must have in there is your profit. I put in $500 a month as a minimum as an expense line item. So I'm not guessing or hoping that I'm going to make money. I know I'm going to make money. So I account for all of those expenses, and then I make sure that I could rent the property for more. But here's the key thing. In your question, this is where it comes down to where I did it wrong the first way. My property manager started stealing from me within 6 months. The right way is before you buy the property, you verify with the experts that you've already built that business. They're going to help you do it. To give you an example, I get a lot of people come to me and say, man, Dustin, I follow those TikTok gurus and I bought a house, spent thousands of dollars to fix it up, spent thousands of dollars to buy it. And then I tried to find a tenant. Nobody would rent it. And then I tried to find a property manager, and all the property managers said, no, they won't manage it because they'll get shot there. I'm like, oh, you don't have an asset anymore. You have a liability. Instead of doing that, what you want to do is you want to build the business first. So instead of calling property manager after you bought the property and say, I already bought this property, will you manage it? They say no. Well, instead of that, when you're building your business, you're going to be able to go to the property manager, the people you've already hired or brought on as somebody that you're going to be bringing on your team or in your business. You call up and say, hey, property manager, I'm looking to buy this property. How much will it rent for? What's the vacancy factor? What's the clientele like? Will you manage it? All these other questions. And if they say no, they won't manage it, then you don't waste the time, money, and effort buying it because you already have the expert telling you. But if they do say, yes, I'll manage it. In fact, experts will be like this. This is how they'll respond. Well, yes, I know that property. In fact, I know that area. We have a property right around the corner, same size and everything. Zillow was trying to tell us we can get $1,800 a month. We tried, we couldn't. Most we can get was 1,700. That is expert information that you will not be able to get from a database, Redfin, Truly, and
Right.
all that sort of stuff. You'll get it from the business that you built and hiring the experts before you buy the properties.
So who are the experts? It sounds like the property manager one.
It's by far, the property manager is by far the number one quarterback of your team. Like the number one position, he's your quarterback. He's going to do everything that's going to make sure you're doing everything right. And a lot of people say, in fact, I'll say it this way. So I have my podcast, you mentioned it, the Master Passive Income podcast. The most downloaded or listened to shows are one of two things: finding properties and funding, how to get money. That's what everybody wants to listen to, which I get it. I started there too, thinking, well, I don't have a property, I don't have money. I got to learn that. That is not like those are last things. The first thing you need to learn is how do you manage a property for longevity of that property? In fact, I have 30 plus properties now, and I will literally give these properties to my kids. I have five kids now. I'll give these properties to my kids in generational wealth, and I'm making money to feed my family every single month. And so what you need, and so they're getting the right people on your team, on your business, the number one is your property manager because they're going to be the ones that manage it for year after year after year. In fact, I never talk to my property managers. They just send me the statements and I get money. If I see anything wrong, then I call them up and say, what's going on? But what I do is I make sure I find the property manager first. Well, before I get there, you need to find the right city. If you find a bad city that is not going to be, yeah. So you want to find a good city that has a lot of good properties in there that you can buy as inventory. When you find a great city, I'll give you a couple examples because I know somebody might be thinking, well, Dustin, where? So Midwest has been really, really great for my students right now. Birmingham is taking off. Memphis is kind of like on the, I won't say downtrend, but like they back in 2019, you should have been investing in Memphis. Now it's kind of you kind of miss that, but Alabama has been getting some good, really good returns. We have places in Atlanta, but like Midwest has been really good, getting up to Indiana, Ohio, really good places. And when you you find a good city has good inventory. Let's say it's Birmingham. You find a good city, has good inventory. The next thing you do not start calling realtors, which most students, I've coached thousands of students. Occasionally they'll say, hey, Dustin, I found a great city. I've already got 5 realtors sending me deals. I say, whoa, 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 wait. If you got and bought one of those properties, who's going to manage that? And they say, I don't know. I said, you're putting the cart before the horse. The first position in your business, the first person that you need to find is a property manager. Then you also, because they're going to be managing it for longevity. Then you're going to find mortgage brokers, then you're going to find inspectors, then you're going to find plumbers and roofers and contractors. You're going to get everybody in the business before you get to the realtors, before you get to anything else. So that's my suggestion is when you build a business, you find the right people. And the number one, in fact, well, I'll say it this way too, because a lot of people ask, well, Dustin, how do I find a good property manager? Just like that convenience store analogy. If you do all the work to build a business and then you buy the inventory, you put it in the business, and then you look across the street and say, hey, you got a pulse. Come on in here and manage my money, manage my company, manage my customers, manage my everything. You would not do that. You would hire by interviewing many, many people to be the manager. You would ask them many questions, many different companies, many different questions to find and vet the right property manager. So that's what I suggest is when you're going to be looking for properties, the first thing you do is find the property manager because you're going to be calling them and saying, is this a good property? How much will it rent for? And they'll help you have the best, most expert advice.
So property managers, one person you need to have on your team. Who are the others?
Went through a couple of them. So your first one is your property manager. Then next would probably be a mortgage broker or some sort of lender. In fact, I'll say it this way too, because I got a lot of people, like I said, they want to learn how to get more financing. I have used and know of 20 plus different ways to get financing, creative financing. So it doesn't have to be where you work 40 plus years of your life and then save and then buy one house. Instead, what we do is it's called leverage or getting a loan for that property. When you find somebody that has money, It could be a bank. It could be a hard money lender. It could be a private money, like your brother or cousin or uncle or dad or something like that, or a bank and a signature loan. You could even take over properties with a subject to, like you take the property over subject to the existing mortgage, or you can assume the loan. I'm just giving you a big broad view. Even a home equity line of credit. I have a give you a quick example. One of my students, his name is Benjamin. He's a pastor up in Sacramento. Didn't have any money. He's like, Dustin, I can't work forever. Help me to invest in real estate. But he had a property he bought in 2017. He had a lot of equity. And so what we did was I coached him. He got a home equity line of credit. This is just one example. Takes that home equity line of credit, buys a home in Atlanta, Georgia. So that new home is free and clear. There's no mortgage on it because the mortgage is on his HELOC, his primary residence. Fixes it up, then rents it out, and then refinances it, pull the cash out, and pays off his home equity line of credit. And he has that money to do it all over again. This is just one of many ways. So, property manager number one. Then you need to find financing. Mortgage brokers are fantastic. A DSCR loan, a debt service coverage ratio loan, is absolutely amazing. I wish those were around in 2006, 7, and 8 when I first started investing because they're so 30-year fixed commercial loans. They're so terrific. But yeah, so property manager. Then find your funding source. And then we need to make sure we find inspectors. And there is a good amount of inspectors. So it's not going to be hard to find inspectors. You also want to start looking for handymen and contractors. Those are going to
Mm.
be very, very helpful. In fact, a handyman is probably one of your best, next to your property manager, a handyman is probably your next best hire that you're going to be able to get because they're going to save you a ton of money. I'll give you a quick another example. When I had turnover on one of my properties in Ohio, and I got a quote from a contractor for $17,000. Apparently, he said, "Oh yeah, let's rip out everything. Make it brand new." I said, "This is a turnover. Tenants moved out, and we got to put new tenants in there. I'm not paying $17,000." So I found a handyman who said, "Oh man, we can make this place look fantastic. $2,000 plus materials, which is only going to be maybe $1,000. So I'm maybe $4,000. So a handyman is fantastic, but you also need to get rehab and repairs when you buy a property that's run down. Those are the main. We get started there, and then the last one. I don't even have realtors on my team. Like somebody might say, Dustin, don't you have a realtor looking for properties for you? I said, I don't have one realtor. I've got dozens of realtors looking for properties for me. And somebody might say, well, Dustin, like what happens if they're looking for property? They're working hard for you. I'm like, if they bring me a deal, I'm going to buy it from them. Like I'm not going to be exclusive. I could only buy through them. Why would I do that? What if they
Yeah.
got a house for sale and then I say, you're exclusive to me. You could only sell it to me. You can't sell it to anybody else. The realtor would be like, why would I do that? I said, exactly. Exactly. Why would I only buy through you? It doesn't work that way. So those are the like there's a lot more we could talk about, but that's the if you go through and build that with that as a
Yeah.
mindset, let's build that foundation, everything else falls into place.
Yeah, it's interesting. It really is all about the people when it comes to building a good business, and they don't have to work for you, right? Everybody you just named is a 1099. They don't work directly for you, but they're part of your team. One of my mentors, we hired him because he worked for a company as CEO for 8 years, grew it, and they sold that development company to Toll Brothers. So we do land development and new construction, and they sold it to Toll Brothers for over $100 million. And I was like, yeah, you're the guy I need to hire. He's like, Brandon, all these businesses, they're all the same. The only difference is the people. And we work with a lot of national home builders. We sell a lot of land to them, and it's funny because I see it's the same business model. They're all building literally the same house. I mean, in the same areas. Uh, but the successful ones, it's all about the people that are in that business. So it really, really is all about the people when it comes to being successful in this. So I know a lot of people right now are struggling. The economy hasn't been great, especially in real estate. I think you might have been the only person that I've heard in real estate saying, like, I don't want rates to go down. Like, oh my gosh, I've not heard that. It's been the opposite. What are some of the things that you recommend people do to give themselves an edge in this new real estate economy that we've been in since 2022? Because the market has changed. How did your business pivot from 2022 when things were blowing and going and everybody was speculating and property values were going through the roof and rates were super low to almost doubling overnight. And, living through the bloodbath that we've seen play out in multifamily and the bridge debt and, the difficulty in the real estate world. So how have you pivoted your business? I gave a lot of context there, but I think
No,
it's
it's great.
important
No,
for the
that
listeners.
yeah, perfect. Be completely honest and straightforward and say the lessons I learned back in 2008 when the crash happened, that's played throughout for since that point to now, and I still make money and I make more money over time. So whether or not the market goes up or the market goes down or sideways, I make money because I invest for cash flow. I want to make sure I'm making money every single month from every single property. But here are the main things that I look for when I buy real estate. When I'm investing in real estate, I want to make sure I make money in 6 different ways. This could be a single family home, also an apartment complex. And so, number one, I want to make sure I'm getting cash flow on the property. I don't buy a property hoping that the value will go up because I know it will. Just over time, and this is statistically proven, every 15 years, real estate doubles in value. And so a $150,000 home in 15 years is worth 300. And at 15 years later, it's worth 600. It's statistically proven over the history of real estate here in America. So that's number one, is I want to make sure that I'm getting passive income. Then that's number one, the first way to make money. The second way to make money is just like I said, what market appreciation over time, the real estate will go up in value. That's the amazing thing. That's number two. Number three is equity capture. And this is the big one that I've seen so many people who invest in multifamily fall apart. The syndicators, they are hurting now because they did not do this third one. The third one is capturing equity. So when I buy a house, just like that one I just told you, I bought it for $67,000. It's worth 150, 140, 150-ish. I put 20 grand into it. So I'm out of total $90,000. It's worth 140, $150,000. Same thing with multifamily or commercial real estate. You need to capture equity. Most syndicators, sadly, they're just flipping deals and they're hoping that the value goes up in 3 to 5 years so they can sell it. That's just what they're doing. It's understandable. It's their business model, but I don't invest like that. I don't invest in deals where I'm hoping the value goes up. And there's a great saying, everybody, like you must know this saying is you make your money when you buy the property, you realize it when you sell it. So I'll give you an example. May of this year, I bought a property, I think it was like $35 million property. We bought it it's in Chattanooga, Tennessee, 325 units. We bought it for $60,000 a unit, which was fantastic because it was a distressed property. The parents passed away, gave it to the kids. They were running it down and we bought it and its value add is going to be great. We bought it for $60,000 a unit. We could have literally turned it around for maybe $105,000 and sold it like fire sale right then and there. We could have done that, but we know over time we'll get the values up. So we'll be able to eventually sell it for 130. But here's the thing. We bought it less than it's worth. And on Monday, from when we're recording this now, on this Monday coming up, we're going to be closing on a 94 unit apartment complex where we're buying it for about $100 to $101,000 a unit. It's near Nashville. And right now we could turn around and sell it for about 120 to maybe 125. It needs a lot of work. It's 60% occupied, which is terrible. Good for us because we're
Yeah.
buying it at a great discount. But we're going to get in there and fix it up, and we should be able to sell it for about 130. So another one. So number one, cash flow. Got to have cash flow because that without cash, your business is dead. Number two, market appreciation. Over time, it just goes up. Number three, equity capture. When you buy it for less than it's worth. Number four is forced appreciation. You put in, let's say, $5,000 in a single family home, and then hopefully it's going to be worth 20 grand. So you capture $15,000 in equity right then and there by forced appreciation. Tax benefits are absolutely amazing. I absolutely love all
Yeah.
the tax benefits that you get. I mean, I pay no money in taxes. Is really what it comes down to because the tax law or the tax code is written by rich people who invest in real estate, and I just follow their plan. The last one is mortgage buy down. The tenants pay for all of that mortgage, all the interest, all the principal, taxes, insurance, like they pay for all that. And so let's say, I'll give you raw numbers. Let's say you bought a house for $150,000 and you could put 15,000, 10% down. We still owe $135,000 and the interest. But $135,000 is paid for by the tenant over 30 years, plus the interest is paid for by the tenant. And so when you look at the 6 different ways that you make money, I don't buy any real estate, single family, multifamily, or whatever, unless I'm doing all of these very, very well. In fact, one quick last thing I'll say, the people that are getting hurt now in multifamily, more than likely it's because they didn't buy it right. If you bought it
Mhm.
right, where you captured equity, then that takes care of so much in the long run. Because if you buy it for less than it's worth, your mortgage is lower, your income comes up, and you could sell it if you really needed to, all that good stuff.
Yeah, I remember seeing those deals come across my desk where there was no underwriting for downside. The upside was there, but there was no wiggle room at all when the downside came. And then, yeah, it is what it is. I've seen a lot of personal bankruptcies in the multifamily world from those then. And it was weird because the market was just so jolty, right? It was like 2021, tons of liquidity, low rates, just boom, everything shot up. And I had some money that actually doubled in a 2 year period in some of those syndications at a time. I invest as an LP too. And then it's like, oh, cool, let's do that again. And put it into some deals in 2022. And then boom, it
I
completely
have
flip flops.
I'm with you. And I have a good friend of mine who he has lost over $1 million investing in as an LP in syndications. And he's like, we got this capital call here, got this capital call there. And I just stopped putting, I just know these are not, I can't keep throwing good money after bad. So it's, it's terrible.
Yeah. Dustin, this has been an absolute pleasure. For those that want to learn more about you, listen to the Master Passive Income podcast, or I think you've got a free course. Can you tell them a little bit more about where they can go?
Yeah, absolutely. I want to help 1 million people to invest in real estate. If you want to grab my course completely for free, people have invested just with this course. You could text the word rental to 33777. Rental to 33777. Or you can go to masterpassiveincome.com/free course. All one word /free course. I'll send it to you. And this course is going to show you how to invest anywhere in the country, how to build the business, how to buy the properties for cash flow, and then eventually, hopefully, scale to be where you have enough properties to become financially independent. And then, so you could definitely get there. You could also listen to me. My podcast is Master Passive Income Podcast, over 2.2 million downloads now. And it's really just a solo show. I just teach how I invest in real estate, just talk about everything. You can check me out there. But one quick last one is I've been actually having a little fun on social media. So my Instagram, I've grown it to 250,000 followers on Instagram organically. I didn't buy any of those, no bots whatsoever. So if you want to find me on Instagram, the Dustin Heiner, Dustin Heiner, and tell me you listen to Brandon's show every single week and how you're growing by listening to his show, and just come reach out to me. I'd love to chat with you.
Dude, I love it, man. Go listen to the show. Go check out the course. We'll see you guys next time.